How can I profit without needing to predict market direction? It's a genuinely fascinating question, right? Because every single day, literally millions of incredibly smart, highly educated investors try to guess whether the stock market is going to go up or if it's going to go down. And honestly, most of them fail. But then you look at the most successful professional options traders, the market makers, the massive institutional desks out there. They aren't trying to guess the future at all. They've completely abandoned the crystal ball. Instead, they are obsessively asking, how can I profit without needing to predict market direction? Well, welcome to this explainer. We are about to completely rewire how you think about market risk.
Okay, let's dive right in. Today, we're unpacking the core concepts from Martin Vika's incredibly insightful guide, The Delta Neutral Trading Blueprint. Now, a quick reality check right up front. This isn't about some magical risk-free profit scheme. No way. This is about a fundamental, total shift in mindset, moving from pure speculation to actual risk engineering. We're going to see how the pros manage risk so intelligently that everyday price bumps in the market barely even leave a scratch on their portfolio.
Here is our quick roadmap for today. We'll kick things off with the prediction problem, run through the basic mechanics of options, decode how option value is actually built, learn the mathematical language of the Greeks, and then, finally, we'll put it all together to achieve delta neutrality.
Let's start with Section 1, the prediction problem. Why exactly do so many traditional investors stumble, even when they have endless data and research right at their fingertips? Well, it really all comes down to mindset. Think about the traditional investor. They buy a stock at, say, $100, absolutely expecting it to jump to 120. If it drops to 90, they lose. Their entire financial outcome is entirely dependent on their ability to predict the future. But compare that to a casino. A casino doesn't sit there trying to predict the outcome of every single spin of the roulette wheel. That would be completely impossible. Instead, they intentionally design games where the odds are just ever so slightly in their favor over thousands and thousands of repeated events. Professional traders, they adopt this exact casino mindset. They don't rely on forecasting every little market swing. They engineer their risk so their long-term expectancy depends on cold, hard probability, rather than just guessing which way the wind blows.
Moving to Section 2, the options foundation. To actually build this casino mindset for ourselves, we need the right tools, right? Enter options contracts.
Just as a super quick refresher, unlike simply owning a stock, an option is a derivative. It gives you the right, but absolutely not the obligation, to buy or sell an underlying asset at a specific price within a very specific window of time. And this structure, it is profound. It's the exact mechanism that allows professional traders to pull off this magic trick of separating market direction from market opportunity.
These contracts essentially come in two main flavors: calls, which you use for a bullish view, and puts, which you use for a bearish view. And combining these gives traders the ultimate flexibility to profit whether the market is ripping higher, crashing down, or even just trading completely sideways.
But remember, every single trade has two sides. On one side, you have the option buyer. They pay a premium up front. Now, they do get limited risk because, hey, you can only lose what you paid, but they usually face a noticeably lower probability of profit. Why? Because they need the market to make a significant move in their direction just to break even. But then on the other side, you have the option seller. The seller is the one collecting that premium, though they do take on the obligation of the contract. So why do massive institutions so often prefer to act as a seller? Because it gives them a massive statistical edge. They are literally getting paid for time passing by, for prices staying relatively stable, and for volatility dropping. Basically, they are playing the casino side of the table.
All right, on to Section 3, decoding option value. If we're going to trade these, we really need to understand how these highly complex contracts are actually priced. A huge part of this comes down to something called moneyness. It's basically looking at the option's strike price compared to where the stock is currently trading. This puts the option into one of three buckets: in the money, meaning it has immediate built-in value; at the money, where it's hovering right at the current price; or out of the money, where it currently holds absolutely zero immediate intrinsic value.
Which leads us directly into the actual pricing formula. The total premium, the actual price you pay for an option, equals its intrinsic value plus its extrinsic value. Intrinsic value is the real stuff. It's the immediate mathematical value you get if you exercise the option right this second. But extrinsic value, that's where things get interesting. Extrinsic value is basically time value. I like to call it the hopes and dreams of future market movement. It's entirely driven by how much time is left on the clock before expiration, the expected volatility, and just general market demand. Think about it.
If you buy an out-of-the-money option, you are paying 100% for extrinsic value. You are banking purely on future expectations.
Section 4. The Greeks and Delta. Managing all these moving parts sounds like a nightmare, right?
Well, that's exactly why Wall Street uses the Greeks.
What's amazing here is how these intense calculus variables just translate into simple, plain English questions. Delta asks, how much does the price move? Gamma looks at risk acceleration. How fast does our risk change? Theta tracks the daily decay. How much value evaporates every single day? Vega measures volatility impacts, and Rho tracks the effect of interest rates. By isolating these specific factors, professional traders take trading completely out of the realm of guesswork and turn it into a precise, measurable risk management machine. But for our blueprint in this explainer, we are going to hyper-focus on the absolute most critical Greek of them all, delta. Delta is basically the ultimate measure of your directional exposure. It simply tells you exactly how much your option's price is expected to change when the underlying stock moves by exactly $1. So if your option has a delta of 0.50 and the stock ticks up by $1, boom, your option just gained roughly 50 cents. So here are the quick rules of the road for delta. Call options, they always have a positive delta, ranging from 0 up to +1. Put options are the inverse. They always have a negative delta, from 0 down to -1. Options that are sitting right at the money usually hover right around that 0.50 mark, either positive or negative. But wait, here is the absolute best secret. The pros also use delta as a quick and dirty cheat code for probability. If you see a call option with a 0.70 delta, that essentially tells you the market is pricing in roughly a 70% chance that the option actually finishes in the money. It is just an incredibly powerful gauge of real-time market expectations.
All right, Section 5. Achieving delta neutrality. Let's take all of these moving parts and lock them together into a real-world institutional strategy.
The actual logic to achieve a neutral portfolio is surprisingly straightforward. It really just takes 3 steps. First, the trader steps back and looks at their entire portfolio to identify their total current directional risk. That's their portfolio delta. Second, they do the math to calculate exactly how much offsetting delta they need to buy or sell using options. And third, they execute the hedge. That flattens their directional exposure completely. Let's ground this with a concrete case study so we can actually see the math in action. Okay, let's say you own 100 shares of company XYZ. Now, every single share of stock naturally has a delta of exactly 1. So your current total portfolio delta? It's +100. That means you are heavily exposed if that stock suddenly drops. To fix this, you open up the options chain. You find an at-the-money put option, and you see it has a delta of -50. So to perfectly offset your +100 risk, what do? You buy exactly 2 of those put options.
And there it is, +100 from your stock shares combined with -100 from your 2 put options leaves you with a perfectly neutral portfolio delta of 0. Think about what that means. If the stock makes a modest move up or a modest move down, the gains or the losses on the shares are totally offset by the inverse changes in the options. You have successfully neutralized your directional risk.
Now let's be crystal clear about the reality of Wall Street trading here. Having a delta of 0 does absolutely not mean your trade is risk-free. Far from it, actually. Because remember, the stock price is always moving and time is always ticking away. That means your delta is going to constantly shift. To stay neutral, you have to do what's called dynamic rebalancing, continuously adjusting your positions. But here is the real magic. What this strategy actually does is deliberately shift your entire focus. Instead of agonizing over trying to guess which way the market will swing tomorrow, your profit engine is now based on harvesting time decay, that's our friend Theta, or trading the actual changes in market volatility, which is Vega. You've stopped guessing and started engineering.
Which brings us to our final thought. As we speak, the traditional investor is out there, glued to a screen, staring at charts, desperately trying to predict what the market is going to do tomorrow. But the professional? They're simply balancing their exposures, making absolutely sure that no single, random market movement can dominate their performance. So, looking closely at your own strategy today, are you still trying to predict the market's direction? Are you finally ready to start engineering your risk? Thank you so much for joining me for this explainer, and I truly hope this changes the way you look at the markets forever. Catch you next time.